Okay, yeah, it's live now. Let's see. Because if they don't come through the link, then I won't know who is here and who's not. But I'll go into. Will I be able to see it from my phone as well or not?
Well, we have 6 people waiting.
Is that what it says?
Yeah.
All
it says
right.
6
Okay.
people.
All
Wow.
right. Okay, that's great. But why can't I see them?
Is that what it says? Yeah. All right. Okay, it's already live.
All right, that's great. Shall I give? Still, we got 1 minute, so you can get started.
Yeah.
We'll give at least 1 minute.
Could you hear that?
Yeah.
A lady talking.
Yeah. Where is that coming from?
I have my computer set programmed to tell me the time.
Right. Okay.
I had no idea that it actually. I need to mute that then.
Okay, John. Do you want to get started? Because it's going to be in YouTube, so
Yeah,
if anyone wants to,
sure.
they could go back on it. Yeah.
Absolutely.
Yeah, fire it away.
Okay, great. Let me just actually mute the lady. Okay, here. And okay, great. Okay, so hello everyone. They're going to be having a very nice presentation about market prices. Now, we were supposed to actually learn a bit more about other things other than just market prices and market structure. But yeah, we were supposed to actually learn a few more things about consumption and production and maybe some inflation. But yeah, this is essential, and that would take too long. And yeah, this way it's going to be quicker if if we see that there is interest from more sessions like this. We'll be sure to prep them. So, how market prices are set? Yeah, it's a very interesting thing that a lot of people don't know, and we all need to know at least the basics of how they are set as ourselves being participants in the market. So let's take a look at what the market is. And the market is the ideal situation where buyers and sellers come together and confront. Now, these buyers, they're going to be consumers, and these sellers are going to be firms, otherwise known as producers. These guys are going to be looking to buy something, and these guys are going to be looking to sell something. Okay, that's obvious. And so they're going to put it out in the market. These guys are going to have demand, and these guys are going to have supply. And from that confrontation between the buyers and the sellers, there'll be a result from that, and that is the market price. The price that the market is willing to give for a certain good. So at this market price, sellers and buyers come together. Their intentions, their selling intentions, and their buying intentions come together to meet at one price. Now, let's also take a look at the two types of markets. By the way, if anyone has any questions, you can put them on the YouTube chat. I'm watching that on my phone. So if anyone has any questions along the way, I will be sure to do my best to answer those questions. Moving on to the two types of markets. There are two types of markets: perfect competition markets and imperfect competition markets. Now, we won't be taking a very big look at imperfect competition markets because the Forex market, the financial markets, are not imperfect competition markets. So I thought that maybe it would be more useful for us to focus more on what we do, what we take part in. So, and that is the perfect competition markets. In these markets, to be a perfect competition market, there are very strict rules. One of them is that all firms sell an identical product, a homogeneous product. So they're all identical. They might have a few differences here and there, but overall, same product sold by all firms. Also, another one of the characteristics of these markets, one of the rules that these markets have to comply with, is that all firms, whether you're a big firm or a small firm, you cannot influence the price of the good. Now, this is due for every single firm, no matter if you have a big market share or if you have a small market share. Let's say that for good X or service X, same thing, we have firm A and firm B. They are selling an identical product, homogeneous product, and firm A actually has 75% of the market share, and firm B has a 25% market share. Firm A cannot influence the price of the good, and firm B also can't influence the price of the good. This is one of the characteristics of the perfect competition markets. Neither firm here, no matter if you have 75% market share or 25% market share, you cannot influence the market. And also, the market is transparent. So whether you're a buyer or a seller, you have the same information. And this is something very important because all firms can enter the market and exit the market. Now, let's take the Forex market. Yeah, the Forex market, any financial market actually works here. The market is transparent. So whether I'm a bank, whether I'm an individual, whether I'm an individual in India or in China or in the US or in England, I get the same information. Everyone gets the same information. We all get the same price information, no matter if the bank gets the information a bit a few seconds earlier than us. It's going to be the same thing. Information is all there. So any market participant can know anything about the market at any given cost, at any given time, I apologize. And then all firms can produce the good, entering and exiting the market at no cost. Let's say that, let's take the example of good A. Right now we have firm A, good X, I apologize. Firm A and firm B are the only two participants, only two firms participating in the market at one given moment. But I want to open a new firm. Let's say I'm going to call that firm B and firm C. Damn, it's not going well today. Firm C is going to produce an identical product, so good X, and I can enter the market, and firm A can enter the market at no cost. I can simply stop production, everything's going to be fine. Now, in perfect competition markets, they're a little bit different. If to be an imperfect competition market, you simply don't don't meet one of these criteria. Simple as that. You know, a few examples of imperfect competition markets: monopolies. So one big firm selling a unique product to the general population, and that unique product, that firm holds all the power to control the price of that product. While here, as you can see, firms do not hold a single they don't hold influence over the market price, and that's one of, as you know, characteristics of perfect competition markets. Now, there are two main principles that are present in the markets, and those two principles are going to interact to give the market price. We saw earlier buyers and sellers. Now, what do buyers have? They have demand. They want something. And sellers, what they have supply. They produce something, they want to sell it. So right here we can see what demand is. Demand is the consumer's desire and willingness to pay a price for a specific good or service. And those specific goods or services are produced by firms who are going to supply it to the buyers or consumers. Now here we can see a nice little graph that we have here in red. This line, so some people say some people call it a curve, even being a nice linear function, but it's still called a curve. And this is called the demand curve right here, because we have demand for all prices and all quantities. So let's say that, by the way, this is aggregated demand. So as you can see here, the demand curve compiles all aggregated demand for all possible prices of a good or service. And that's what we have here. So let's say that for price A, right here, buyers are going to desire A quantities of good X. So right now we're talking about good X right here. And then we also have, for price B, we have a bigger, greater quantity than right here for price A. So every single point right here is basically represents price for quantity. So these right here we have quantities that consumers are looking to acquire, and here the price for which the consumers are willing to acquire those very goods. Now, yeah, that's basically it. So technically you could say that there are infinite... No, that wouldn't work. Yeah, because it's not a real function. Okay, moving on to what can influence demand. Now, the most important thing is income, right? Because let's say that at any given year, so let's say year X, at year X, I have an income of £1,000. And with that income, I'm going to look to acquire maybe... This is a very unrealistic number, but I'm going to look to acquire 5 units of bread, right? And my income from year X plus 1 is going to be £1,300. Technically, that is going to make my demand for bread grow. And that's what we have right here. So this is the original demand curve. So D1 right here. And these factors, they're all going to influence demand. And what's going to happen when one of these factors actually changes, the curve is going to shift either to right or left. Now, if the curve shifts to the right, that means there's more demand. So let's say that quantity A is right here, quantity B is right here. We can clearly see that quantity B is greater than quantity A. So demand grows for the same price. Same thing here. We have price A. For price A, we have quantity A right here. And with the new demand curve, for price A, we actually have a greater quantity being demanded by consumers. So income is one of the most important factors that's going to influence demand. Another one is the price of substitute goods. Now, substitute goods are those, so let me see if I can find an example. Let's say, So substitute goods are basically, I have good A and good B, Now, these two goods serve the same purpose. They are different, but they all serve the same purpose. So let's say that we have two goods. We have good A and good B. Or we can also put this in terms of the financial markets. We have stocks and we have bonds. Very easy word. So we have stocks right here. Let's say that prices of stocks are going to grow. Now, that might take some participants off the market because they don't recognize the value of that stock. And so these consumers, these buyers that were looking to buy stock A, they are going to shift the demand to bond A. And that's going to make bond A's demand grow. And that's right here. So let's say that this graph right here is the demand, the graph that has demand for bond A. And this is the original demand curve for bond A. If stock A increases in price, that's let's say that's going to make investors move over to bond A. Demand grows, curve shifts, and we're going to see why this is very important later on in this presentation. So we have price substitute goods, marketing, which is a very important thing nowadays. We are bombarded with ads everywhere we go, and it really a good ad campaign can make your demand for a product go crazy. It really is. So population, that's an easy one. If I have a good, so good A that is a primary good, so a good that's going to be looked consumers almost every consumer is going to look to buy this good. If population increases, we're going to see an increased demand for that product because it's a primary good. If on the other hand, if population decreases, we're going to see a decrease in demand for good A. And last one there are many more. The last one we have here is the trends. So, let's say that khaki chinos are very trendy right now, and they weren't maybe a few months ago. Demand for khaki chinos is going to increase demand. And anyone has any questions so far? Okay, moving on to supply. So supply is the second force that interacts with demand, and supply is connected to producers, so firms. And firms interact, they are going to participate in the economic activity called production. They're going to produce goods that's going to be demanded by the population. So supply is the total amount of a specific good or service that is made available to consumers by firms. So these firms are going to produce goods, and they're going to make it available, make those goods available to consumers who are going to look to acquire those very goods. Right here we have the same thing as we had for demand, except here it's for supply. You can see that the curve is actually, so right here we have a negative sloped curve, and here we have a positive sloped curve. So, this would be kind of like if we had this as a function, because there is a function called a supply function and the demand function. This could be maybe f of x equals x, and f of x equals x, and here we have yeah, f of x equals k over x. So very interesting. And so the supply curve, as the demand curve for demand, the supply curve is going to compile all aggregated supply. So all the supply for a good, for all available prices of a good or service. So right here we have quantity A. Let's say this is quantity A, and this is quantity price A. I'm sorry, and this is quantity B. This is price B. You can see that consumers, as price went down, consumers were more willing to buy a certain product. So let's say price A goes down to price B. Quantity demand quantity is going to increase from quantity A to quantity B. So that's what happens in demand. The reverse happens in supply. So we have price B right here, with price A, I apologize, and we have quantity A, and here we might have price B and quantity B. We can see that as price increases, we're going to see a desire from producers to actually produce more. So it's going to it's kind of like an incentive to that production, a bigger price. And so that leads us to what influences supply. Now, same thing we have here with same thing we had with demand. We're going to have here with supply. We have supply curve right here. This is the original one, so supply 1, and this is supply 3, supply 2. Oh, we didn't actually discuss a shift of the curve. No problem, we can do it right here. It's going to serve the same purpose. So right here we have the original demand curve, and these two are after these factors have actually changed. So one of the most important ones when we are talking about supply is the production costs. Now, production costs are divided in two sections. So we have fixed costs, and we have the other costs that do change as production changes. So fixed costs won't change. But let's say that firm A maybe wanted to produce more. Technically, they would have to spend more. So production costs would increase. But that's a very interesting thing, that production costs increase, but the production cost of a unit actually might decrease. Very interesting thing. You know, we can cover that in a future section if we have people interested in that. And production costs. Let's say that production costs for good A increase. So that means that the supply curve is going to shift. And where is it going to shift? It's going to shift to the left because there is less supply. Production costs went high, so firms are not going to be as willing to produce the same amount of goods as they were before the production costs actually went higher. So that's going to come here. So if we had quantity A right here, you can price A. So price A right here, it's a line. Let's say it's right here. When you know, where let's say that there is a line right here in these arrows. So this is price A. You can see that in the original demand supply curve, we have price A. Price A. It's not going to equal the price of the new quantity A. I apologize. Quantity A is going to be greater than quantity B. That's going to equal the point. It's going to be one of the coordinates of the point B that is right here. So very, very easy production costs. You know, this basically the principle this principle applies to all of these factors and all factors that anyone can find. Supply supply increases, so curve is going to go to the right. Supply decreases, curve is going to go to the left. Consumer expectations. Yeah, I mean, that's an easy one. Let's say that consumers, same thing with trends. Consumers are going to want more of a certain product. So that means that basically producers are going to increase the quantity supplied to consumers, and that's going to make the supply curve actually move to the right. Purchasing power expectations, that is a very important one. Purchasing power is one of the most important indicators in the economy, because without purchasing power, an individual, a family, cannot acquire goods. So if we have expectations that the purchasing power in a given country is going to decrease, maybe producers are actually going to decrease their inventory and their supplied quantities, because they know that with a lower purchasing power, the consumers are not going to be able to actually buy the same amount of goods as they did otherwise, and so they're gonna basically decrease their production. And we have weather conditions. This is an easy one. Let's say we have a farm. If we have bad weather conditions, the farm's not going to be able to produce as much quantity of goods as it would otherwise. So supply curve is going to move. Supply curve is going to move to the left. And one I forgot to actually put it here. One very, very important thing should be here is the price of oil, because the price of oil moves basically everything. Right now we live in a global world. So let's say that I am a producer here I'm a producer in England, and I want to export my goods to America. Now, my goods are not going to be exported, by not going to be carried by a bird. They're going to be carried by planes or ships, and these use oil. Now, of course, you can make the argument that airlines and freighting companies are going to use futures to edge against big moves, but an increase in oil price would also mean there'll be an increase in costs for the freighting of my goods. So that means that I wouldn't really, it wouldn't be profitable for me to produce as much as I would. So supply curve is going to move to left. The reverse happens with decreasing oil prices. So that was a quick look at both demand and supply. Anyone has any questions?
Right. Can I just stop you for 1 second, John? Yeah,
absolutely.
Because a lot of guys probably thinking, what does that got to do with Forex? This is what when I'm actually seeing this. Probably a lot of guys thinking the same. What does that got to do with Forex? That is a hugely important to know this, especially if you are a long-term trader. Or if you're a fundamental trader, you must. Well, I'm not really a fundamental trader, but I still have to know certain things. John, who is very, very detailed, he would analyze the economy before he decide to take his trade. So it all depends what kind of trader you are. I don't know if you watched my other video before when I was saying 4 types of traders. This is actually the main one. The investors, they don't trade every day, but they need to do they do the research through this economy, supply demand of the specific country, whatever the currency they're trading, they will do the whole year of research before they put the trade on. They're not going to look at the chart to say up and down. They'll be monitoring the country's economy, how good and how bad it is, and based on that they will be taking the trades. So a lot of guys probably thinking, what does that got to do with the supply demand?
Yeah,
Forex is all about supply and demand. You see on the
absolutely.
chart, trend line, this line, that line, it's all about what John actually sharing here. John is using a lot of technical words, but it means exactly the same. If you visualize it in a chart, it works exactly the same way, supply and demand. So guys, take notice of this. Write down notes as well, because especially fundamental traders, just remember, fundamental is the leading indicator in Forex, in financial market. So you got this, you got an upper hand. So guys, take notice of it. Right, thanks for that.
Yeah. No, thank you very much for that. And actually, we're going to get to how supply and demand interact to meet at a certain price for a good. Now, this is what happens in every financial market, being a perfect competition market. Supply and demand are going to interact to actually get to a price, and that is what we see every single day. So the formation of a market price is very simple. So we have the supply curve right here. We have the demand curve. So we put them in the same graph. We can do that because we have the same things here. So we have price on this axis and we have quantity on this axis. So we can technically do that. And we have supply, demand. Now, in perfect competition markets, the price is set by an equilibrium price. So this is the price where producers are willing to supply the same amount of goods for the same amount of monetary units as consumers are willing to actually buy those products. So we can see that that is where the two curves actually cross right here. So we have quantity A right here. Okay, so this is quantity A. We have and we have price. Let's say that. So this is price 1. This is price. So let's say that this is price E for equilibrium. Right here is where the demand curve, the supply curve are going to meet. So the market price is actually PQ. Now, right here we have a kind of an interesting formula to actually. This means exactly what I said, that the price is where both of the forces are willing to come together. So we have the demand function at price P and the supply function at price P. They're going to equal the same, and that equals a quantity. And so this is the actual market price. Above this market price, we have an excess supply. And below this market price, we're going to have excess demand. So let's take a look at excess supply first. So as we said, we have above equilibrium price, we have excess supply. As you can see from the curve, and as I said earlier, producers are more willing to produce their goods if they are sold at a higher price. Of course, they want profit. Everyone wants profit. And so above this price, the supply curve is going to go there. The inverse actually happens with demand. Now, would you rather buy bread at £5 a unit or £1 a unit? I believe I would much rather buy bread at one price a unit than £5 a unit, and that's what happens here. consumers do not want to buy, they are not as willing to acquire goods when prices are high. And so there is a much bigger quantity of goods being supplied to the public than they are demanded. So excess supply, to counteract this excess supply, producers are going to have to bring the price down to the equilibrium price. Same thing happens here with excess demand. Producers don't want to sell their products at a low price, and they want to sell it at high prices. But we do have consumers who want to acquire the same good for a low price, and so we have excess demand. Demand is bigger than supply, all the way up to the equilibrium price. Now, we saw here that the curves could actually shift. And this is a situation that occurs many times. So we have original curves, and we have a shift in the curve. Now, we can say that, let's take the euro dollar. The euro dollar and the dollar, Canadian dollar. They are both identical products. They all serve the same purpose, right? That they all have common characteristics. And so let's say that Euro USD is basically a much better position for investing than dollar CAD. So dollar CAD, the buyers for dollar CAD are going to actually shift their demand over to Euro USD. And what's going to happen is that demand for Euro USD is going to grow. And so price is going to get bigger, right? That's what we see every day. Demand increases, price increases, right here. And that's what we have. This is the original equilibrium price. The demand curve shifted to right, and so we need a new equilibrium price. And demand quantity increases, and market price is going to increase as well. So we're going to come here. As you can see, price is higher. Moving on to in the long run. Now, this technically wouldn't happen in the Forex market, because technically you can, but you wouldn't increase the supply of currency in an economy. I mean, unless you are doing quantitative easing, yeah, you do increase the amount of currency actually flowing in the economy. But yeah, let's say that this is the market for blue jeans. That works. And the market for blue jeans is a perfect competition market. We had demand shift to the right, so more demand. And what's going to happen with more demand? Producers are going to want to produce more because they're seeing demand increase, and they see an opportunity to increase their profits. So they are going to supply more units of the same product. And that is where shifts in the supply curve are going to come in. This is the original supply curve. This is the one after the shift. So right here, it goes here. So we had shift from here. This is the demand curve, original one, and this is the one with increased demand. We had an equilibrium price right here, a new equilibrium price. But now the producer has actually increased their supply of blue jeans. And what's going to happen with more supply for the same demand? We're going to have a decrease in price, and this is the new equilibrium price in the long run. The same thing can happen with stocks. Let's say this one really, it's not very usual for this to happen, but it can happen. let's say that firm A wants to go public, and they're gonna actually put in the market 10 million shares. Okay, so they see demand for these 10 million shares increase, and a year later they're going to increase the amount of shares that are being traded in the exchange by 3 million. With more supply, that means that the price for the stock would actually decrease. And this really is what happens almost every day, right? In Forex, this is what happens. Supply meets demand. And actually, let me see if I can find the report. It's an old Merrill Lynch report. Yeah, right here. Let me just get here. This isn't it. Basically, it's a report about long-run investing in currencies. It doesn't have what I wanted to say, but in the short term, in Forex, we have purely speculative forces moving the market. So nobody gives a damn whether interest rates increase or interest rates decrease. Nobody the participants in the market don't really care about that. In the medium term, we're going to have a combination of speculative forces and fundamentals. So we already have some fundamentals, so economic indicators actually come in the equation. In the long run, the only thing that matters is fundamentals. Technicals don't really matter in long run. What matters is the economy doing good? How is the consumer's behavior? Consumers more willing to buy more products? Have wages increased? Has purchasing power increased? Because that's as we saw in the supply, and as one of the things that actually influences supply. And these are the only things that's going to matter in the long run. Technicals don't really come in. The only thing that comes in for technicals, let me actually, where's the call? Let me actually, where's my PDF? Okay, right here. Come on. Can everyone see my PDF?
Yeah,
The one with okay. So basically, let's see if can I. No, I can't. Yes, here. This is what I wanted. Okay, that's nice. Great. So we have here the long-term equilibrium path, and this is the equilibrium. Basically, the equilibrium price for the currency. There are going to be moves above and below the equilibrium line right here. And the market's going to counteract that because here the currency is overvalued, here the currency is undervalued. And nobody's going to care whether Fibonacci retracement is telling me buy, or Fibonacci retracement is telling me to sell, or we have an harmonic pattern. Nothing's going to matter here. Everything's going to matter is the economic data. And that's what I tried to show in this brief presentation, is how the price is formed, because price of a currency pair is formed like that: supply, demand interacting, and they all meet at a price, and that price changes constantly, as we know. Now, that's that's it from me. I'm going to take questions now if anyone has them.
No, John, I don't really have any. I totally got understand what you're actually trying. It was a really good presentation. But a lot of new guys probably be a bit confused in terms of what does actually that got to do with trading. It's everything that John actually shared. I mean, obviously, you need to learn more into it to get upper hand in forex or any financial industry. Fundamental, it drives the market. That's the bottom line. Fundamental is the leading indicator. So you get upper hand on this, and you are a good technical trader. You got um, you got pretty much upper hand on everybody else. It's a lot of them. A lot of traders are mostly either technical or fundamental. But if you got combined two of them together, you got the full package. So that is the reason that you need to understand the fundamental side as well. Even a technical trader, you need to learn that as well. So that was really good presentation, John. And
Thank you.
and in the future, if you could do a session on fundamental trader, I don't know if you if you're able to, that'd be great because this is your specialty.
Sure.
So
I'm actually currently reading a Deutsche Bank report on long run currency investing.
All right. Okay. I think that would be really good.
Maybe if I finish it if I finish reading the report in the next few weeks, while I have time, we can do another session.
Yeah, no, it's no rush. Just in the future, that'll be really helpful, even to myself as well. Because as you know, in terms of fundamental side, yes, I do know all the stuff I need to know. But just to get yourself to another level, that would be something helpful. That'd be great helpful. As I said.
If we see demand for it, I can also do a session on production and consumption. Two things that really move long run fundamental data. The CPI, inflation, purchasing power.
That would be really good. That would be really good because you're not going to find that in internet. Those information you're not going to find on the internet. You're not going to even the book maybe, but you have to dig into it. So that would be something worth booking yourself into, to be honest. And we'll arrange that, John, and I'll post it. We'll arrange a date and time, and then we'll post it. And
great.
That'd be fantastic. Right, thanks a lot, guys, for joining in and tuning in. Any questions, anything, just leave in the comment. One of us will answer back. And
I'll be checking the comment section. See if anyone has any questions.
Yeah, definitely. So enjoy your evening or morning, wherever you are, and our trading start from tomorrow again. So yeah, take care, man.
Thank you very much.
All right, thanks a lot.
Bye-bye.
Bye.